I've become a real fan of covered call ETFs in this semi-retired phase of my investing journey. So much so that today we're kicking off a brand new series on the channel. A long-term look at how my favorite covered call ETFs perform over time. As many of you know, there are a lot of dangerous covered call ETFs out there. Some of them mix gut-based stock picking with derivatives. And to me, that's a recipe for disaster down the road. But there are a few high quality options built on my two favorite indices, the S&P 500 and the NASDAQ 100. I personally prefer the NASDAQ 100 because the higher volatility index boosts the options income for this strategy. And in this series, I'm going to track the ongoing results of my absolute favorite covered call ETFs to make sure that I am riding the right horses for the long run. If you're new to the channel, welcome. My name is Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. And if you enjoy these videos, drop the hammer on that like button, subscribe if you haven't already, and consider joining the channel membership. It helps keep this section short and sweet. You know what time it is. Let's grow. Covered Call ETF Overview. Before we dive into the nerdy data, and you already know that I have the nerdiest stuff around, we need to talk about who covered call ETFs are made for. And there are far too many use cases to list, so I think it's easier to flip it around. Covered call ETFs are not for most people in the accumulation phase with a decade or more before retirement. Over long stretches of time, you will lose to the low-cost ETF that tracks the underlying index. And this is not my opinion, it's simple math. You own the same underlying stocks as the index, but you agree to cap your upside in exchange for reinforcing your floor with that juicy cash flow. Let me show you an example of this theory in reality. I pulled up QQQI, the NEOS NASDAQ 100 High Income ETF, out here on Seeking Alpha. And again, Seeking Alpha is where I do all my stock and ETF research and portfolio aggregation and screens and everything. I love it. I do have an affiliate link if you're interested in trying premium for free. But I pulled up QQQI because it is our middle performing NASDAQ 100 ETF, and we'll get into all that later. And then I also pulled up the NASDAQ 100 index itself, this low cost ETF of QQQM. That's how you directly invest in the NASDAQ 100. It's the best one that I know of. And you'll notice as I hover over them, I have 840 days worth of data since 1/30/2024. You can see the same on both. And the reason I picked that date isn't random or arbitrary or cherry picking. That's when QQQI had its inception and first started getting data. Before we dive into how this works and why people in the accumulation stage really want to ride that low cost ETF for the underlying index itself, like QQQM or VOO if you're talking S&P 500, I want to clear up a huge misconception I get in my comments. Whenever I show this thing you're looking at right here, you can see in the time since inception, QQQI is up a nice 57% compared to QQQM 70%. Now listen, this is assuming that every dividend is reinvested to buy as many shares of QQQI as possible. This is total return. I always get the argument, yeah, but if you looked at total return, then QQQI would show its power because you could take those dividends and reinvest them. No, sir. Let me show you. Select metrics, performance, price return. This is without dividends reinvested. Now, of course, this isn't apples to apples because it doesn't make sense, right? You get a much higher yield with QQQI, but I'm just saying, this is the one you think I'm showing. What I'm really showing to those people is total return. This is fully reinvested. This is everything. And you see QQQM wins. Now, we actually have some great data for the floor capping of QQQI. I want to point out right here where my mouse is, follow me. And we're not going to zoom in on the data as far as the date range. We're just going to do this. It was within 1.5% just a couple months ago on March 26th. But if you go to now, it's way up. Well, I don't know why I'm hovering. You can see the now here. So from 1.5 in 2 months, that's all in an up market. What you're doing with a covered call ETF like QQQI is you're capping your ceiling. See, this is not going up as much to get that guaranteed income. But The same can be said only for the opposite on the downside. And I'm going to hover right here. QQQM got out to over a 5% lead early on, but then the market went down. And guess what? They're about tied. They're within 1% here. So QQQI outperforms on the down because your ceiling isn't capped because it's falling anyways. So the strike prices aren't met and you're getting that guaranteed income and you have fewer shares in the underlying index dropping, if that makes sense. So it always works like this. Always, always, always. And over time, the market will go up when we zoom way out. And therefore, the higher expense ratio and the ceiling capping will hurt you, even with the downs and the ups and the downs and the ups. So I can't emphasize enough. If you're young and you're building wealth, even with dividends reinvested, please go with VU and the QQQMs of the world. And I'm going to show this briefly. I don't want to be too long on this section for the S&P 500. All right, I'm back and I changed what we're looking at here. And you can see we still have QQQI pulled up, but I just pulled in some new tickers here. So same concept, SPYI and VU. So this is the covered call from NEOS, and this is the underlying index, low cost. And you can see I have more data here. It's from 8/30/22. I just looked where I could pull from SPYI, the more the merrier, but it's the exact same concept. When the market goes up, you can see VU runs away, and that's that capped ceiling for the guaranteed income. And there's not a ton of down. Let's just look. I did not look at this, by the way. I do all these screen shares live, 100% of them. Never scripted. We have about a 17% lead here. And I bet it will get closer. Down here, it's only 12%. So SPYI won by 5% on this drop. And that's that floor protection. You have fewer shares of the underlying index dropping because some of those are tied up in options, which ultimately put premium income in your pocket. And you didn't lose, I say that in quotes, on the underlying index for that portion. So it's the same, only opposite when the market goes up. And now again, I haven't looked at this. It's about 17% and it should get bigger. And it did, 26%. So no homework, just to prove this is raw and live and authentic. Just take my word for it. It is how it works. But there are those of us that need that cash flow now. And for that group, the best NASDAQ 100 covered call ETFs do a surprisingly good job of delivering high income while keeping the market's overall performance. The cap ceiling and raised floor tend to smooth out into something that looks like the S&P 500 as far as total returns, with a lot more cash flow. But even within the NASDAQ 100 covered call space, not all ETFs are built equally. And in this ongoing series, we're going to discover the best of the best. We'll be focusing on what I consider to be the highest quality NASDAQ 100 covered call ETFs on the market today. And that's GPIQ, I call it GPIQ, QQQI, and JEPQ, and I call it JEPQ. Let me go ahead and stop talking so we can dive in. The results. The thing that I care about the most with covered call ETFs is ironically the total return. And yes, I use them for the cash flow, and of course the total yield has to be solid. But if net asset value erosion is persistent, the fund won't be around long enough to pay anything. Cash flow only matters if the underlying engine stays healthy. Now with that said, it's time to jump into my shiny new spreadsheet, which you can download for free, link in the description below, that compares these behemoths on dividend yield, dividend growth rate, price CAGR for that NAV erosion, and total returns. You're gonna like this one. Here it is in all of its glory, and I just realized it's probably not overly impressive, but stick with me, this is pretty cool. So what we have here is a dynamic spreadsheet where you can punch in the year and the month that you want to see where GPIQ, QQQI, and JEPQ were at the time. So for example, if you put in month 3, it goes to their price CAGRs and all the data after the third dividend of the year. But we're gonna go to 4 because this is the most recent one I've updated. And you can see I updated on 5/8/2026. I was waiting for JEPQ to pay its 4th dividend of the year at the time. And by the way, there's tabs on this. This one's out there. It's spreadsheet number 14 on the free spreadsheets. But you can, like, this is the QQQI tab. I realize you can't see my tabs because I'm zoomed in for you, but it has all the raw data. You can see it's paid 4 dividends this year, and it has the traditional schedule, whereas JEPQ's paid 4, but it's kind of weird. It just the way it does it. So, but it's apples to apples because it's the 4 dividend payments this year for each one, and then this is GPIQ. Feel free to come out here on the server, open up the spreadsheet to look at this extra nerdy data for each ticker, but we're going to live here on the summary. So after the 4th dividend paid in 2026, we have the yield, the 1-year dividend CAGR, that's the 1-year dividend growth rate, just like we look at with SCHD and friends, the 1-year price CAGR for that NAV erosion, and the 2-year price CAGR. Because as I come out here, you can see that we actually have 2 years of data. When I hit F2, you have this, and as long as you have 2 years, you're good. Whereas the dividend CAGR, I need the trailing 12 months to compare, so I don't have 2 full years of that for context. That's why only price has 2, but I'll be adding metrics as these things get older. They only date back to the youngest one for the comparison's sake. So looking at the categories, you can see that QQQI, if you really care about that yield, that cash now, it is the best, a 14% yield as of the last payment. And then GPIQ and JEPQ are virtually tied at 10.4, 10.5. And then on the 1-year dividend growth rate, you have 7.4% for GPIQ. And I noticed as I went through all the months and nerded out with this data, it does grow at the best consistently. And now in this one, QQQI ties up JEPQ. They're at about 4%. Now on the 1-year price CAGR, this is to make sure NAV isn't eroding. We had a good year, so this one's a little goofy. Usually this is more flat because of the high yield. For the second half of the total return, you have the price. 23% is absurd, but that's really good, 23.5%. But you can see GPIQ smokes QQQI, and even JEPQ beats QQQI. And now on the 2-year price CAGR, and so this one's looking back even more, the more data, the better. GPIQ's grown its price, no dividends included, just price, 11.6%. QQQI comes in last place at 5.5, and JEPQ at 6.7. Now, total return is the thing that puts everything together. Yield bleeds into it, price bleeds into it. It's all total return. This one is the one I care about because we know we're going to get ours. We know we get that cash flow, but you got to make sure you're also growing. So when you put it all together, and again, this is as of 5/8, and right now I record this on 5/21. So we'll probably pop out to Seeking Alpha to get a little update here at the end. But you could see in 2025 last year, GPIQ won with almost a 20% total return, dividends included. QQQI was right there at 18.62, and JEPQ was at 15.18. So GPIQ is the big winner, but QQQI is right there. Now, 2026 year to date, we have 10% for GPIQ, and a pretty distant second at 6.81, and then JEPQ struggling at 5.34. This one right here on the far end is the most important. This is over time. What's the total return in our pockets? And for GPIQ from 2/1/2024, when we started getting data for all of these, again, that's not arbitrary, we have a 57% return for GPIQ, a 52% return for QQQI, and a 46% total return for JEPQ. So as of right now, with just the data we have, and we're still pretty young here, I heavily prefer GPIQ. Oh, and you know what? I need to add a return to capital table. I'll do that for next month. See, I have some homework, because I will tell you, JEPQ is 0% return to capital. Ouch. And so it's not even really a contender, because I do this in a taxable account because we need the cash now. I just have this here because I know a lot of people have it. I used to have it, and it's good to have another reference point. But QQQI was 99.6% of return to capital, which means 0 taxes paid on 99.6% in 2025. And GPIQ was 96%. So that just means that it pushes the taxes down the road and it turns them to those nice, juicy, long-term capital gains. When your cost basis eventually hits 0, you have to pay taxes, but it's all long-term. By then you might be in that nice 0% tax bracket. It's just an investing hack to get that return of capital instead of these ouchy, painful, ordinary dividends from JEPQ. But let's pop out to Seeking Alpha to get an official scorecard right now, and we'll make it quick because I've blabbed enough. All right, and I still had QQQI pulled up in Seeking Alpha. That's fine, this page works. And this is interesting. You can see that lifetime, and again, it's that 840 days. We have to go by the youngest one for comparisons reasons. We're on total return here, dividends reinvested. This is exciting to me personally. I added VU in the mix. I snuck it in there because, you know, why not? And you can see that our friends QQQI and GPIQ have outperformed VU total return since inception. And remember, in a taxable account, their taxes are more friendly than VU. You pay close to 0% taxes on this, and it converts them into long-term capital gains later on down the road. Whereas VU, you have to pay your qualified dividends taxes, which isn't too bad. But it's just crazy because these are actually objectively better in this time duration. We will see what happens moving forward. I don't want to get too crazy here. We never know. This is all pretty new. And then JEPQ has just come in way back in the caboose at a 48% total return. It just has not performed well by comparison, and I can't emphasize enough, it comes with those terrible taxes. Ordinary income, not even qualified dividends like VU. This is as if you made more money from your job, and it can push you to a higher marginal tax rate in a taxable brokerage account. I should note, a lot of people ask in the comments, if you have these, all of these in a retirement account, traditional IRA, or a Roth, taxes are irrelevant. In traditional IRAs, any gains will be ordinary income when you take it out. Basically, you pay taxes on it. Or in a Roth, of course, no taxes at all. So JEPQ is fine in those. I get that question a lot. But yeah, here's the performance. And the last thing I'll blab about, let me get rid of JEPQ here. Look at the trends. This is what's crazy. And the blue one's QQQI, by the way, the out of kilter. But like that upside, the upside capping and the floor protection on a more volatile index in general weirdly mimics the S&P 500. I've always found that fascinating. And you know, I don't know that this will continue for sure, just to be clear. But it's not that they're just tied overall with weird different spikes. They're really competing evenly over time. And I just find that interesting. I'll take the market returns with all the cash flow and no taxes. Yes, please. Right out of the gate, GPIQ stacked up incredibly well. Well enough that it has me thinking about the future of my personal portfolio. Closing thoughts. I've owned all three of these ETFs at different times. I started with JEPQ because that was the first one that I got to know. But as I dug deeper into the data, I quickly pivoted between a split of GPIQ and QQQI because of the stronger performance, but more importantly, the major tax advantages they offer in my taxable brokerage account. And at one point, I had moved the entire position to QQQI after reading that GPIQ doesn't return nearly as much as capital. But after confirming that GPIQ paid 96% as return of capital for 2025 last year, I dove right back in. Right now, I'm sitting at the 50-50 split between GPIQ and QQQI. But I'll be honest, if GPIQ posts another year of over 90% return of capital, I'm seriously considering moving the entire position over because of its superior metrics. Either way, both ETFs are incredible in a taxable account for semi-retired people or fully retired people that need that cash flow. And speaking of an incredible group, I'd like to give a huge shout out to my incredible channel members. We are now 37 strong. And an even bigger shout out, in this one particularly, to the new channel members. And that's MB, Andrew, and John. I really appreciate it, you guys. Your support, along with all these other wonderful people that you see on the screen now, really does keep me going. I can't emphasize that enough. You keep this process of making YouTube videos fun, and I look forward to the future. And then a huge shout out to my 2 affiliate links that I use, not sponsors, but Snowball Analytics is right on the tail end of a sale. I made a post about it just in case you were looking for it, but you can still check it out and try it for free. And then Seeking Alpha Premium, not yet, so don't use my link yet. But it is going on sale, the big summer sale, 25% off for a full month. And I'll get the exact dates to you soon. So do not use my link yet. But if you're waiting for Seeking Alpha, a juicy deal is coming, so stay tuned. And as always, check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.